Good morning, good afternoon, good evening, wherever you are in the world today. My name is Alex Tapia, President and Founder of Aviation Retirement Strategies, providing independent financial advice and private wealth management to airline pilots from all carriers since 2004. We give you the tools and advice you need to take advantage of the ever-changing financial world and help you take care of the business end of your professional aviation career. Thank you for tuning in to our podcast channel, bringing you up-to-date, relevant, independent information so that you can make sound financial decisions for yourselves, your family, and your eventual retirement from the airlines. Don't forget to hit the subscribe button so you can stay up to date on any relevant and timely information we bring to the professional aviation community. You can also visit us online at www.pilotmoney.com or follow us on social media on all the major platforms. Welcome to the Pilot Money Podcast. Hello, everybody. Good afternoon, and thank you for joining me. My name is Alex Tapia. I'm the president and founder of Aviation Retirement Strategies and ARS Private Wealth. Today is Tuesday, it's June 14th, and the S&P 500 is officially in bear market territory after Friday's report that showed inflation is spiking at the fastest rate in over 40 years. Right now, it is about 10 minutes to market close, and it looks like the markets have been kind of looking for a general direction all day because we are all waiting on the reports from the Federal Reserve meeting. That's a two-day meeting that started today, and they're going to announce tomorrow what they're going to be doing about interest rates. The general consensus has been that they're going to be raising the interest rates by 0.5%, or what we call 50 basis points. But based on Friday's numbers, it looks like they may be raising the rates up to maybe by 75 basis points or 0.75%. So we're going to wait and see what happens with that. Everybody's talking about inflation, and it's all over the news, and we're waiting on some key numbers tomorrow. So what exactly does all of that mean? Well, inflation is the overall rise in prices of goods and services over time. The annual inflation rate in the United States averaged 3.27% between 1914 and 2022. So modern inflation has been a fact of life in the natural economic state for well over a century. It's actually not that big of a deal, and it's really not that bad of a thing for an economy. But it makes it important to distinguish between the inherent effects of inflation of any rate and those that only come into play during periods when inflation runs unusually high, like it's doing right now. So in this segment, we're going to try to identify inflation's most important effects on the consumers, the investors, and the economy, and how we can potentially position ourselves during the market volatility that times like these can bring. So let's get started. Now, probably one of the most well-known effects that inflation has on the economy is the fact that it erodes your purchasing power. This is inflation's primary and most pervasive effect. An overall rise in prices over time reduces the purchasing power of consumers. So put in a simple way, inflation just erodes the value of your dollar over time. The amount of inflation dictates how fast that actually happens. If the standard inflation is 2% and then doubles to 4%, the value of your dollar erodes twice as fast. Everyone in America today is understanding this concept each and every time they take out their wallet. Probably one of the lesser-known effects that inflation has on the economy is the fact that it hurts the low-income segment disproportionately. Lower-income consumers tend to spend a higher proportion of their income overall and on necessities than those with higher incomes, and so they have less of a cushion against the loss of purchasing power inherent in inflation. This is what economists mean when they note that lower incomes correlate with a higher marginal propensity to consume. Policymakers and financial market participants like ARS often focus on the core inflation, excluding the prices of food and energy, which tends to be more volatile, and therefore it's also less reflective of the longer-term inflation trend. But lower income wage earners in developed economies, and most people in developing economies, spend a relatively large proportion of their weekly or monthly household budgets on food and energy commodities hard to substitute when inflation hits and the prices spike. Also, people with lower incomes are also less likely to own assets like real estate, which in the past have traditionally served as an inflation hedge. We'll talk more about that later. If you think about it, inflation keeps deflation at bay. The Federal Reserve actually aims for inflation at 2% over the long term to meet its mandate, which is actually stable prices and maximum employment. It actually targets some modest inflation rather than aiming for steady prices. Because the slightly positive inflation rate actually greases the wheels of commerce, it also provides a margin of error in the event inflation is overestimated, and it also deters deflation, which is the overall decline in prices, and that can be much more destabilizing than the comparable inflation. Also, inflation allows lenders to charge interest rate to offset inflation likely to devalue repayments of a loan. Also, it helps borrowers service debt by allowing them to make future repayments with actual inflated dollars. So, actually, when you have a little bit of inflation, it's actually a symptom of a very healthy economy, and it's not something that's likely to cause inflation expectations to rise. For example, if inflation was 2% last year and is 2% this year, it's mainly background noise. Businesses, workers, and consumers would all likely expect inflation to remain at 2% in the next year in that scenario. But when the inflation rate sharply accelerates and stays high, expectations of future inflation will eventually begin to rise accordingly. As those expectations rise, workers will start demanding larger wage increases, and employers pass those costs on by raising prices on output, setting off what we call a wage price spiral. In the worst case scenario, bad policy responses to high inflation can end up in hyperinflation. Now, hyperinflation occurs when there is a significant rise in money supply that is not supported by economic growth. When more money is put into the circulation, the real value of the currency decreases and prices will rise. One extreme example of hyperinflation was when the Zimbabwe dollar was introduced in the 1970s and it was at par with the US dollar. By virtue of irresponsible money printing policies over time, that currency was so devalued that by the mid to late 2000s, they were literally producing bills of $100 trillion. The root cause of such a scenario is the increase in money supply caused by government printing and injecting more money into the domestic economy or to cover budget deficits. Obviously, governments and central banks around the world have a very powerful incentive to keep inflation in check. And in the US and around the world over the past century, the approach has always been to manage inflation using monetary policy. When inflation threatens to exceed a central bank's target, typically 2% in developed economies and 3 to 4% in emerging economies, policymakers can raise the minimum interest rate, which drives borrowing costs across the economy higher by constraining money supply. As a result, inflation and interest rates tend to move in the same direction. By raising interest rates as inflation rises, central banks can dampen the economy's risk appetite, and then suddenly the expected monthly payment on that boat you just bought may seem a bit high, which theoretically should dampen the demand, which should also lower prices. Meanwhile, the risk-free rate of return available for newly issued Treasury bonds will tend to rise as well, which rewards savings. Although a little bit counterintuitive, high inflation actually can lift growth and employment in the short term. Elevated inflation discourages savings since it erodes the purchasing power of the savings over time. That prospect can encourage consumers to spend and also businesses to invest. And as a result, unemployment often declines at first as inflation climbs. Now, for a time at least, higher inflation can spur demand while lowering inflation-adjusted labor costs, which eventually fuels job gains. Eventually, though, the bill for that persistent high inflation has to come due in the form of a painful downturn that resets all expectations for everyone. If not, chronic economic underperformance will occur, much as like being experienced today in countries like Argentina. High inflation can also cause painful recessions. The trouble with the trade-off between the inflation and unemployment is that prolonged acceptance of higher inflation to protect jobs may cause inflation expectations to rise to the point where they set off an inflationary spiral of price hikes and pay increases, similar to what happened in the US during the stagflation era of the 1970s. To regain lost credibility and convince everyone again it would control inflation, the Federal Reserve was subsequently forced to raise interest rates much higher and to keep them higher longer. That, in turn, caused unemployment to soar and to stay higher for longer than would likely have been the case had the Fed not allowed inflation to get out of control and spiral to such high levels to begin with. From an investment standpoint, high inflation tends to hurt bonds as well as growth stocks. Now, normally bonds are lower risk investments providing regular interest income at a fixed rate. Inflation, and especially high inflation, impairs the value of bonds by lowering the present value of that income. As interest rates increase in response to rising or elevated inflation, so does the yield on newly issued bonds. The market price of bonds issued previously at a lower yield then drops proportionately, since bond prices are the inverse of bond yields. Investors holding a treasury bond are still in line for the expected coupon payment, followed by the principal repayment at maturity, but those who sell prior to maturity will receive less than as a result of the increased market yields. Also, growth stocks, which tend to be more expensive, are notoriously allergic to inflation, which discount the present value of their future cash flow more heavily, just as it does for the high-duration bonds. This is what you've seen this year. Since January, the high-growth stocks like Netflix, Apple, all of those companies have significantly dropped because they're high-growth stocks because of this reason, because of the rising inflation. So technology and consumer stocks have lagged during the past periods of high inflation historically, or rising inflation as well. Now, also from an investment standpoint, we know that high inflation also boosts real estate, energy, and value stocks historically. Now, real estate has historically served as an inflation hedge, since landlords can protect themselves against inflation by raising rents, even as inflation erodes the real cost of fixed rate mortgages. Also, to no surprise, energy equities, real estate investment trusts, and value stocks have historically outperformed during episodes of high or rising inflation. So finally, as we try to navigate the current situation for our clients that we're in today, we know that right now, a highly diversified portfolio is the best place to be, especially for those that are at or near retirement. We're actually contemplating overweighting our holding towards the sectors that tend to benefit from high inflation, such as the value sectors and possibly energy and real estate, while also making sure that we keep the maximum liquidity so that we can adapt to sudden changes as well. It's an ongoing process, but if you'd like to learn more about your specific portfolio, please give me a call anytime. We're always available. But for now, thank you for listening. We appreciate your time. My name is Alex Tapia, President and Founder of Aviation Retirement Strategies and ARS Private Wealth. Thank you for listening, and we'll talk to you soon.